Imagine it is January 1st, 2000. You have worked your tail off for 20 years. You have finally managed to save a clean $100,000 in your brokerage account, all tucked away in a nice, reliable S&P 500 index fund. You have seen the charts. You know the history. You are expecting that steady 10% climb to carry you into the sunset. Now, fast forward 10 years. It is December 31st, 2009. You have lived through a decade of world-changing events, 2 different presidents, and countless personal milestones. You open your account statement expecting to see a number close to $250,000. Instead, you see $91,000. You didn't just fail to make money, you actually lost money. In nominal terms, your annualized return was negative 0.95%. After inflation, you are effectively down 20% or more in terms of what that money can actually buy at the grocery store. This isn't a scary campfire story for investors. It is recent history. It is what we call the lost decade. And if your retirement plan assumes this can't happen again, you are playing a very dangerous game with your future self. Before we dive into the math of how to survive a flat market, I want to be very clear about why we are talking about this today. Most financial advice you find online is built on the up and to the right fallacy. It assumes that if you just wait long enough, the S&P 500 will solve all your problems. But for someone 5 years away from retirement, or someone already living off their portfolio, long enough is a luxury you might not have. Understanding the mechanics of a lost decade is the best ROI you can get on your time today. It is the difference between retiring with confidence and being forced back into the workforce at age 70 because the market went sideways. If you find this kind of deep dive data helpful, do me a favor and hit that subscribe button. It tells the algorithm that people actually want to hear the truth about risk, not just the hype about the next AI stock. We are building a community of people who would rather be prepared than surprised. Let's look at the actual numbers from that stretch between 2000 and 2009. It is easy to say the market was flat, but that doesn't capture the emotional roller coaster of actually living through it. You didn't just wake up 10 years later with less money. You were hit by 2 of the most brutal bear markets in modern history. First, the dot-com bubble burst. From 2000 to 2002, the S&P 500 shed nearly half its value. It was a slow, grinding decline that made people question if the new economy was a total sham. Then, just as the market finally clawed its way back to new highs in 2007, the global financial crisis hit. In 2008 alone, the index fell nearly 37%. From the peak in 2007 to the bottom in early 2009, you were looking at a drop of over 50%. Think about that. You waited 7 years just to get back to even, and then, within 18 months, half of your money vanished again. When we say the annualized return was negative 0.95%, it sounds like a small rounding error. But when you are living it day by day, watching your hard-earned savings evaporate twice in 10 years, it feels like the end of the world. It wasn't a straight line to zero. It was a jagged saw blade that cut both ways. The folks over at Dimensional Fund Advisors have a great way of framing this, which they call the tale of 2 decades. It is the perfect illustration of why recency bias is so dangerous. If you look at the period from 2010 to 2019, the S&P 500 was an absolute powerhouse. It returned about 13.5% annually. If that is the only decade you have experienced as an investor, you probably think making money in stocks is easy. You buy the dip, you wait a few months, and you get rewarded. But that decade was only possible because the one before it was so miserable. In the 2000s, investors were actually fleeing stocks. They were convinced that real estate was the only safe bet, right up until 2008 proved them wrong. Before 2000, people were used to the double-digit returns of the 90s. They thought the party would never end. The 2000s were a cold bucket of water to the face. The key takeaway here is that the market doesn't owe you a positive return over any specific 10-year window. We will look at a specific portfolio structure in a moment that actually made money during this time, but first we have to realize that the S&P 500 is not a monolithic force of nature that only goes up. It is a collection of companies that can and do stay underwater for a very long time. I often hear people say, "Well, Tom, even if the price was flat, surely the dividends saved the day." It is a fair point. Dividends are the unsung heroes of total return. But in a truly lost decade, dividends often just act as a small bandage on a major wound. If the price of the index is down 1% a year, and the dividend yield is 2%, you are still only up 1% before inflation. And that is the real killer: inflation. During the 2000s, inflation averaged around 2.5%. If your portfolio is growing at 1% and life is getting 2.5% more expensive, you are losing purchasing power every single day. Most people track their number, the balance on the screen. But the number doesn't matter if it buys half as many eggs and gallons of gas as it used to. A lost decade in nominal terms is a catastrophic decade in real terms. This is why a pure S&P 500 strategy is actually much riskier than the historical average suggests. It is high-octane growth when it works, but it is a lead weight when it doesn't. We have to look beyond the US borders to see how much worse this can actually get. And for that, we have to talk about the ghost of the Nikkei. If you think a 10-year flat period is bad, let me introduce you to the Japanese stock market of the late 80s. On December 29, 1989, the Nikkei 225 hit an all-time high of nearly 39,000. At the time, the Japanese economy was the envy of the world. People thought they were going to buy up every piece of real estate in Manhattan and London. Their companies were the gold standard of efficiency. If you were a Japanese investor in 1989, you felt invincible. Then the bubble burst. In the first 2 years of the 90s, the market plunged 60%. But here is the part that should keep you up at night. It didn't just bounce back. It didn't take 10 years to recover. It took over 30 years just to get back to those 1989 levels. For 3 entire decades, domestic equity investors in Japan who bought at the peak were in the red. That is not a lost decade. That is a lost generation. It is a complete failure of the buy and hold mantra if you are only holding one country's stocks. When I see people today putting 100% of their money into US tech stocks because they only go up, I see the shadows of Tokyo in 1989. This isn't just a Japan problem either. The US has had its own long, sideways grinds that people conveniently forget when they are looking at long-term charts. The 1966 to 1982 period was another 17-year stretch where real returns were essentially zero. When we look at a log chart of the US stock market since 1871, it looks like a beautiful, smooth staircase. But if you zoom in, you see these massive flat plateaus. From 1966 to 1982, the Dow Jones Industrial Average started at about 1,000 and ended at about 1,000. 16 years of volatility, inflation, and drama, and the price was exactly the same. If you were trying to fund a retirement during that time, you weren't just bored, you were desperate. Inflation was rampant in the 70s, meaning that $1,000 in 1982 bought a fraction of what it did in 1966. The psychological toll of this is hard to overstate. Most investors break long before the 10-year mark. They see their neighbors making money in gold or real estate or whatever the fad of the day is, and they abandon their strategy right at the bottom. The reason a lost decade is so dangerous isn't just the math, it is the fact that it makes you want to quit the game entirely. And as we are about to see, if you are nearing retirement, quitting isn't an option, and the math becomes even more unforgiving. If you are in your 30s, a lost decade is actually a gift. You are a net buyer of stocks. Every month, you are putting money in at lower prices. accumulating more shares that will eventually roar back to life. But if you are 62 and planning to retire next year, a lost decade is a financial execution. This brings us to a concept called sequence of returns risk. Most people focus on their average return. They think, if the market averages 7%, I can take out 4% and be fine. But the market doesn't give you 7% every year. It gives you 30% one year and -20% the next. If you get those negative years right at the start of your retirement, while you are also pulling money out to pay for your mortgage and groceries, you are compounding your losses. You are selling shares when they are on sale, which means you have fewer shares left to participate in the eventual recovery. Two investors can have the exact same average return over 30 years, but if investor A has bad years at the beginning and investor B has bad years at the end, investor A might run out of money in year 15, while investor B dies with a multi-million-dollar surplus. The sequencing window, the 5 years before and after you retire, is the most critical decade of your financial life. Let's put some hard numbers to this. Imagine you retire with $1 million in the year 2000. You decide to follow the famous 4% rule, taking out $40,000 a year, adjusted for inflation. By the end of 2002, after the dot-com crash, your $1 million portfolio has shrunk to maybe $600,000 because of market losses and your own withdrawals. Now you need that $600,000 to generate the same $40,000 a year. Your withdrawal rate has effectively jumped from 4% to nearly 7%. That is not sustainable. Then, just as things start to look up, 2008 hits. Your portfolio gets sliced again. Even though the 2010s were a massive bull market, your portfolio might have been so depleted by then that there wasn't enough capital left to benefit from the growth. You can't bake a cake if you've already eaten all the flour. This is why the research from Morningstar is starting to suggest that a truly safe withdrawal rate in today's high valuation environment might be closer to 3.3%. They are building in the very real possibility that the next 10 years look more like the 2000s than the 2010s. If you ignore this and stick to the old rules, you are betting your retirement on a coin flip. So, how do you actually build a portfolio that doesn't just sit there like a decorative rock for 10 years? The answer is the one thing everyone hates to hear when the S&P 500 is booming: diversification. During the S&P's lost decade of 2000 to 2009, not everything was losing money. In fact, if you looked outside the US large cap space, it was actually a pretty decent time to be an investor. Emerging market equities, for example, had a fantastic run during that period. Global bonds provided steady income and capital appreciation. Small cap stocks and value-oriented stocks significantly outperformed the tech-heavy S&P 500. The league table of asset classes from 2000 to 2010 is almost the exact mirror image of what we have seen over the last decade. Back then, the US was the laggard and the rest of the world was the leader. Today, it is the opposite. But here is the thing: these cycles always turn. The investors who survived the 2000s weren't the ones who predicted the crash. They were the ones who were globally diversified. They didn't bet everything on one index. They held developed markets in Europe and Japan. They held emerging markets like Brazil and China. And they held high-quality bonds. When the US was flat, their other engines were still humming. Diversification is the only free lunch in investing, but it only tastes good when your main course is spoiled. Beyond just geographic diversification, you can diversify by factors. This is a fancy way of saying you should own different types of companies, not just the biggest ones. Dimensional's research shows that over the full 20-year window from 2000 to 2019, a portfolio that tilted toward small-cap companies and value companies, those that are cheap relative to their fundamentals, actually beat a pure S&P 500 allocation. Even though the S&P had that monster run in the 2010s, the outperformance of value and small-cap in the 2000s was so significant that it carried the day. Most people are closet indexers. They buy an S&P 500 fund and think they are diversified because it has 500 companies. But those 500 companies are all large-cap US stocks, and right now, they are heavily concentrated in just a handful of tech giants. If tech goes sideways for a decade, the S&P 500 goes sideways. If you own a broader slice of the market, small companies, value companies, international companies, you are giving yourself multiple ways to win. It is about not having a single point of failure. We are going to look at the boring part of the portfolio next, the part that everyone ignores until the building is on fire. Let's talk about bonds. In a world of crypto and triple leveraged QQQ, bonds sound about as exciting as watching paint dry. But in a lost decade, bonds are your best friend. They serve two vital purposes. First, they provide stability. When the S&P 500 is down 37% like it was in 2008, high-quality government bonds are often flat or even up. They act as a shock absorber for your portfolio, keeping your total account balance from cratering. Second, and more importantly, they are your dry powder for rebalancing. Rebalancing is the process of selling what has gone up and buying what has gone down. In a flat decade, the market isn't just sitting still, it is oscillating. It goes down, it comes up, it goes down again. If you have a sleeve of bonds, you can sell some of those bonds when stocks are in the gutter to buy more shares at a discount. This buy low, sell high happens automatically when you maintain a target allocation, like a 60-40 split. Research from Looney Doctor shows that shifting to a 60-40 portfolio during that critical 10-year retirement window can cut your volatility nearly in half. You might give up a little bit of the average return, but you drastically increase the odds that you won't run out of money. In the game of retirement, staying in the game is more important than winning big. Speaking of staying in the game, I want to invite you to join a special group of people here on the channel. We call them the Optimizers. If you look down near the subscribe button, you will see a join button. By becoming a member, you get a few cool perks, like custom sketch badges that show up next to your name in the comments, and priority replies when you ask a question. But more than that, you are supporting the kind of deep dive, no-nonsense financial education that we do here. We don't have sponsors telling us what to say, so our only loyalty is to you and the data. If you want to help us keep the lights on and get a little extra recognition for being a serious investor, click that join button. It is a small way to become part of the inner circle here at Tom Talks Money. Now, let's get into the advanced stuff, the strategies that work when both stocks and bonds fail. There is a nightmare scenario that investors rarely talk about. What if both stocks and bonds go nowhere? We saw a glimpse of this in 2022 when inflation spiked and both asset classes fell in tandem. If we enter a long period of high inflation, the traditional 60-40 portfolio might struggle. This is where alternatives come in. Now, I am not talking about alternative as in some shady crypto scheme or a private equity fund with high fees. I am talking about liquid alternatives that have low correlation to the traditional markets. Things like managed futures, trend-following strategies, or real assets like commodities and tips. Catalyst Funds has done some interesting research on positioning for a lost decade in both stocks and bonds. They suggest that adding a long-short sleeve, essentially a strategy that can profit when markets go down as well as when they go up, can buffer a portfolio during flat or bear markets. The goal here isn't to hit a home run. It is to find an asset that moves to its own beat. If the S&P 500 is a rock and bonds are a hard place, you need something that acts like a sponge. By diversifying into assets that don't rely on equity growth, you create a portfolio that can generate positive returns even when the main market is broken. It is about building a ship that can sail even when there is no wind. If the math of a lost decade feels overwhelming, there is one lever you have total control over: your spending. The biggest mistake retirees make is assuming they have to take out a fixed, inflation-adjusted amount every single year, regardless of what the market is doing. This is what the 4% rule is built on, but in reality, it is a very rigid way to live. Instead, successful retirees use flexible withdrawal rules. This means that in a year when the market is down 10%, you might skip your inflation adjustment or cut your discretionary spending by a small amount. Conversely, in a monster year where the market is up 20%, you don't just spend all the gains, you cap your increase to keep a buffer for the bad years. This guardrails approach allows you to take out more money on average while drastically reducing the risk of a portfolio meltdown. It is about being an active manager of your own life. If you can be flexible by just 5 or 10% in your annual budget, you can survive a lost decade that would bankrupt someone following a rigid rule. We often focus so much on the return side of the equation that we forget the spending side is where the real power lies. So, let's wrap this up into a practical protocol you can actually use. Rule number 1. Accept that lost decades are a normal part of market history. They are not black swan events. They are the price of admission for long-term gains. If your plan breaks if the S&P 500 returns 0% for 10 years, your plan is broken. Rule number 2. Diversify geographically and across factors. Don't be a US-only investor. Hold developed markets, emerging markets, and value tilts. This ensures that even if one engine stalls, the others can keep you moving. Rule number 3. Manage your sequence risk as you approach retirement. This means adding high-quality bonds or even a tips ladder 5 years before you plan to stop working. Think of it as an insurance policy against a bad start. Rule number 4. Use a conservative withdrawal rate. If you are retiring today, assume 3.3 to 3.7%, not 4. If the market does better, great, you can spend more later. But start with a margin of safety. And finally, rule number 5. If you are still in the accumulation phase, pray for a lost decade. A flat market is a 10-year sale on the most productive assets in the world. Your new contributions and your rebalancing will be the primary drivers of your wealth during those years. The lost decade is only lost if you stop participating. The S&P 500 is a wonderful wealth-building tool, but it is not a magic wand. From 2000 to 2009, it proved that it could go nowhere for a very long time, leaving a generation of investors stranded. Japan proved it could stay underwater for 30 years. These are the cold, hard facts of the financial world. The investors who thrive aren't the ones who get lucky and pick the next Nvidia. They are the ones who build portfolios designed to survive the worst-case scenarios. They hold global stocks, boring bonds, and they keep their spending flexible. They don't bet their entire future on a single index or a single country. As we move into an era of higher valuations and uncertain growth, the lessons of the lost decade are more important than ever. Don't let a decade of zero catch you off guard. Build your plan today so that 10 years from now, you are the one looking back with a smile, while everyone else is wondering where their money went. If you want to see what a sample asset allocation looks like for your specific retirement horizon, leave a comment below with your age and your risk tolerance. I can't give specific advice, but I can sketch out the math for you. Thanks for watching and stay optimized.